the telecom giant that swapped fiber for fiction. In the late 1990s, as the internet revolution reached fever pitch, telecommunications companies became the darlings of Wall Street. Among these digital gold miners, none seemed more promising than Qwest Communications International, a Denver-based upstart that claimed it would rewire America with the world's most advanced fiber optic network. Led by the charismatic Joseph Nacchio, a former AT&T executive who promised to transform the sleepy regional phone company into a national powerhouse, Qwest appeared to be riding the perfect wave. The company's stock soared from $12 per share in 1997 to $64 by March 2000, giving it a market capitalization that briefly touched $50 billion. Investors were mesmerized by Nacchio's vision of a fiber optic superhighway stretching across 14 western states, capable of carrying the explosive growth in internet traffic that everyone believed would continue forever. What those investors didn't know was that beneath Qwest's gleaming corporate headquarters and sprawling network operations centers, executives were orchestrating one of the most sophisticated accounting frauds in telecommunications history, turning phantom transactions and fictional revenue into real stock options and bonuses worth hundreds of millions of dollars. The foundation of Qwest's deception rested on a financial instrument that legitimate telecom companies used sparingly, but Qwest executives wielded like a magic wand: capacity swaps. In the genuine telecommunications business, capacity swaps served a legitimate purpose when two companies needed to exchange network access in different geographic regions. For example, if Company A needed fiber capacity in Los Angeles but had excess capacity in Denver, while Company B faced the opposite situation, they could swap equivalent amounts of network capacity, with money changing hands only to balance any differences in value. These transactions, when conducted properly, involved real operational needs, genuine network integration, and actual customer traffic flowing across the exchanged infrastructure. However, Qwest's executives discovered they could manipulate these swaps to create the illusion of revenue growth without any corresponding increase in actual business activity. They developed what became known as hollow swaps, transactions where Qwest would sell network capacity to another company while simultaneously purchasing an equivalent amount of different capacity from the same company, often at identical or nearly identical prices. These transactions generated no net economic benefit for either party, created no new customer relationships, and required no additional operational capabilities, but they allowed both companies to book the gross proceeds from their respective sales as revenue, artificially inflating their top-line growth figures. The mastermind behind this scheme was Robin Saliga, Qwest's chief financial officer, who worked closely with Nacchio to develop increasingly complex variations of the basic capacity swap fraud. Saliga, a certified public accountant who had previously worked at US West before its acquisition by Qwest, understood exactly how to structure these transactions to exploit gaps in accounting standards and regulatory oversight. She created a sophisticated system where Qwest's finance team would identify other telecommunications companies facing similar pressure to demonstrate revenue growth, then propose mutually beneficial swap arrangements that would boost both companies' reported sales figures. The timing of these swaps became crucial to Qwest's quarterly earnings management, with Saliga often orchestrating multi-million-dollar transactions in the final days of each reporting period to ensure the company met Wall Street's revenue expectations. Between 2000 and 2002, Qwest entered into capacity swap agreements worth over $3 billion, with the vast majority of these transactions serving no legitimate business purpose beyond financial engineering. The company's internal emails, later discovered by federal investigators, revealed that executives explicitly discussed using swaps to make the numbers work and congratulated each other for creative solutions, when particularly large swap deals helped Qwest exceed analysts' revenue projections. As the capacity swap scheme evolved, Qwest's executives became increasingly brazen in their manipulation of accounting rules, developing new variations that pushed the boundaries of financial fraud. They began engaging in round-trip transactions where the company would sell capacity to a vendor who would then immediately sell identical capacity back to Qwest, allowing both the initial sale and the subsequent purchase to be recorded in different accounting periods to maximize their impact on quarterly results. Qwest also pioneered bill and keep arrangements where the company would provide network services to other carriers while receiving similar services in return. But instead of netting out these reciprocal arrangements, they would record the gross value of services provided as revenue while burying the costs of services received in operating expenses. The company's accounting team, led by Seliga, created elaborate documentation to support these transactions, including technical specifications for network capacity that existed only on paper, service-level agreements for phantom network connections, and invoices for infrastructure that was never built or activated. By 2001, these fraudulent revenue recognition practices had become so integral to Qwest's financial reporting that the company literally could not meet its earnings guidance without them, creating a vicious cycle where each quarter required larger and more complex swap transactions to maintain the illusion of sustained growth. The human cost of Qwest's fraud extended far beyond the executive suite, destroying the retirement savings and financial security of thousands of employees who believed in the company's mission. When Nacchio joined Qwest in January 1997, he implemented an aggressive stock option program that tied employee compensation directly to the company's share price, encouraging workers at every level to purchase Qwest stock through payroll deductions and retirement contributions. Many employees, particularly those who had joined the company after its merger with US West in 2000, invested their entire 401k accounts in Qwest shares, believing management's repeated assurances that the company was positioned for explosive long-term growth. The company's internal communications consistently reinforced this message, with Nacchio regularly hosting town hall meetings where he proclaimed that Qwest's fiber optic network would become the foundation of the new economy, and that employees who remained loyal would be rewarded with unprecedented wealth creation. Meanwhile, even as they encouraged rank-and-file workers to buy more stock, Qwest's senior executives were systematically selling their own shareholdings, with Nacchio alone disposing of over $250 million worth of Qwest stock between 1999 and 2001. These sales were carefully timed to occur during periods when the fraudulent capacity swaps had artificially inflated the company's reported performance, allowing insiders to capture maximum value while ordinary employees and external investors remained unaware of the accounting manipulation. The collapse of Qwest's elaborate fraud began in 2001 when telecommunications industry analyst reports started questioning the sustainability of capacity swap revenue across the entire sector. As the dot-com bubble burst and internet traffic growth slowed dramatically, it became increasingly difficult for Qwest to find willing partners for its hollow swap transactions, forcing the company to offer increasingly generous terms to maintain its artificial revenue stream. Several telecommunications companies that had previously participated in swaps with Qwest began refusing to enter new agreements, recognizing that these transactions were attracting unwanted scrutiny from auditors and regulators. The company's external auditor, Arthur Anderson, initially provided favorable opinions on Qwest's capacity swap accounting, but by early 2002, even Anderson began expressing concerns about the business rationale for these transactions and their impact on the company's financial statements. Internal pressure mounted when Qwest's own accounting staff began raising questions about the propriety of certain swap deals, with several employees filing whistleblower complaints that eventually reached the Securities and Exchange Commission. The final blow came when major customers started canceling contracts and demanding refunds, claiming that Qwest had failed to deliver the network capacity and service quality that had been promised in their original agreements, revealing that much of the company's supposed infrastructure expansion had never actually occurred. When the Securities and Exchange Commission launched its formal investigation into Qwest's accounting practices in February 2002, the scope of the fraud quickly became apparent to federal investigators who discovered a paper trail of fraudulent transactions stretching back nearly 4 years. The SEC's examination revealed that Qwest had systematically violated generally accepted accounting principles by recognizing revenue from transactions that lacked economic substance, manipulating the timing of revenue recognition to smooth earnings fluctuations, and failing to disclose the extent to which its financial performance depended on non-recurring capacity swap deals. The investigation uncovered internal emails where Qwest executives explicitly discussed the need to find creative ways to make our numbers and celebrated successful completion of swap transactions that had saved the quarter by providing last-minute revenue boosts. Federal investigators also discovered that the company had maintained two sets of financial projections: official forecasts that were shared with investors and analysts, and internal models that accurately reflected the company's deteriorating operational performance and its growing dependence on accounting gimmicks to meet earnings targets. Perhaps most damning, the SEC found evidence that senior executives had received detailed briefings about the questionable legality of certain capacity swap structures, but had chosen to proceed anyway, calculating that the personal financial benefits outweighed the legal risks. The criminal prosecution of Qwest's executives became a landmark case in the government's broader crackdown on corporate fraud following the Enron and WorldCom scandals. In April 2007, after a lengthy trial that featured testimony from dozens of former Qwest employees and telecommunications industry experts, Joseph Nacchio was convicted on 19 counts of insider trading for selling stock while possessing material non-public information about the company's deteriorating financial condition. The jury found that Nacchio had systematically dumped his Qwest shareholdings during periods when he knew the company's reported results were artificially inflated by fraudulent capacity swaps, generating personal profits of over $100 million at the expense of ordinary investors who lacked access to accurate financial information. Nacchio was sentenced to 6 years in federal prison and ordered to pay a fine of $19 million, while also facing a separate civil penalty of $71 million imposed by the Securities and Exchange Commission. Robin Saliga, the chief financial officer who had architected much of the capacity swap fraud, pleaded guilty to a single count of insider trading and received a 2-year prison sentence along with a $5 million fine. Several other senior executives, including former Chief Marketing Officer Brian Treadway and former Chief Operating Officer Afshin Mohebi, also pleaded guilty to various charges related to the accounting fraud and received prison sentences ranging from 18 months to 3 years. The financial devastation caused by Qwest's fraud extended far beyond the executives who orchestrated it, ultimately costing shareholders, employees, and creditors over $36 billion in losses. When the company's stock price collapsed from its peak of $64 per share to less than $1 in 2002, pension funds, mutual funds, and individual investors who had relied on Qwest's fraudulent financial statements lost their investments entirely. The company was forced to restate its earnings for the years 1999 through 2001, reducing reported revenue by over $2 billion and converting what had appeared to be substantial profits into massive losses. Qwest's employee stock ownership plan, which had held over $800 million in company shares, became essentially worthless overnight, wiping out the retirement savings of more than 30,000 current and former workers. The company's creditors, including major banks and bondholders who had financed Qwest's supposed network expansion based on fraudulent financial projections, were forced to write off billions of dollars in loans and investments. Beyond the immediate financial losses, Qwest's fraud contributed to a broader crisis of confidence in the telecommunications industry that made it more difficult for legitimate companies to raise capital and invest in genuine network improvements. The capacity swap accounting techniques pioneered by Qwest were subsequently adopted by other troubled telecom companies, amplifying the sector's problems and delaying the recovery that was needed to support continued growth in internet infrastructure and services. The Qwest fraud stands as a cautionary tale about the dangers of allowing short-term financial engineering to substitute for genuine business strategy, particularly in rapidly evolving industries where technological promises can easily mask fundamental operational weaknesses. The company's executives convinced themselves that their accounting manipulation was merely a temporary measure, to smooth out quarterly fluctuations while they built the revenue base needed to support their ambitious growth targets, but the fraudulent practices quickly became an addiction that consumed increasing amounts of management attention and corporate resources. The capacity swap scheme ultimately prevented Qwest from addressing its real operational challenges, including an inadequate sales organization, unreliable network infrastructure, and a corporate culture that prioritized financial metrics over customer satisfaction. Even more troubling, the fraud created perverse incentives throughout the organization, rewarding employees who could engineer complex financial transactions while marginalizing those who focused on improving service quality and operational efficiency. The legacy of Joseph Nacchio's leadership at Qwest demonstrates how quickly a corporate culture can be corrupted when senior executives prioritize their personal financial interests over their fiduciary responsibilities to shareholders, employees, and customers. Today, more than 2 decades after the Qwest fraud was exposed, the telecommunications industry continues to grapple with the long-term consequences of this deception, as investors remain skeptical of complex revenue recognition practices and regulators maintain heightened scrutiny of any transactions that appear to prioritize accounting optics over economic substance.